Welcome to TheoTRADE. This is Don Kaufman. It's September 15th, 2023. Just about 19 minutes to go to the cash close here on this Friday afternoon. All quiet on the inflation front. Of course, that's going to be the topic of conversation here on this weekend's update. Why? Because we got the Fed coming back to town. It's been a while, of course, since the last Fed meeting, but even more importantly than the Fed, bonds, they seem to they're coming back to life literally in the last two trading sessions. I'm going to cover that here in just a couple of minutes, but let's just break down some of the trade that is right in front of us right now, because this entire kind of trading week came down to, well, today. What are we looking at today? The S&Ps taking a bit of a hit. They are down some 57 handles right now. With all due respect, it seems like a big move, but on a percentage basis, I mean, come on, we're only like a 1.2% loss. Nasdaq almost facing a 2% loss. We can dream, right? Volatility's got a little bit of a bid under it, but people, look, it is a triple witching. There's a ton of hedges coming off, and that's actually one of the things I'm going to discuss here. Well, right now, let's start to break this down, what I call all quiet on the inflation front. Obviously, we got some inflation data throughout the course of the week. We're going to look at a bit of that as well. But again, let's start with tech, because what we've seen, and I was talking about this on last weekend's update, we've been seeing this constant, bifurcation within tech itself. And by that, I simply mean if we take a look at something like Microsoft, I'll use Microsoft as an example. Microsoft's getting smashed a bit today, down about 2.3%. But on days lately that Microsoft's been down, it's like Google pops back to the upside. And if Google were down, that hasn't been down in a while, but if Google were down, God forbid, we've seen Meta actually pop back to the upside. But today, we're seeing correlation. And even more importantly and appropriate, if you will, for a big down day, financials, they're down about 0.6%. All right. And if you take a look at today's trade, this hasn't been, just all downside activity. What's interesting about today is here in the financials. And again, as I was saying a moment ago, like the entire trading week, I know we had a couple of up days, and Thursday we popped to the upside, ironically on what was also some rough inflation data. We popped to the upside on Thursday, but this morning, like the financials out of the gate this morning, they were higher. They've been fading hard throughout the course of the day. Even more importantly, take a look at the energy sector, which it has been on fire. It's just been ripping to the upside. If you look at auto expected moves, the significance of the move is we were at the upper edge of the expected move yesterday. Today now we've pulled back dramatically. As I was saying with tech, tech is taking what I would term a collective hit everywhere you look across the board, especially in terms of expected moves. I mean, Meta throughout the course of this week was ripping to the upside. Today, Meta may finish the week unchanged. Again, a little perspective here, right? I know that we're having a down day, or, a down session right now, But if we take a look at the SPX, the mother of all products, in the SPX, we're only down very mildly, on the entire week. For the most part, this is close enough for me to start screaming massively unchanged. Yesterday, we were at the upper edge of the expected move. But again, on Wednesday, as I said, the week was pretty much unchanged. I was like, all the volatility is going to come out on Thursday and Friday. And that's exactly what we have seen. And again, this is no pat on the back to me. It's just, look, there's a huge amount of gamma risk, and that gamma risk just got unleashed in the last 2 days of trade to the upside of the expected move. Here we are. But again, all this has really done is taken us back to basically unchanged in the week. Moreover, if you take a look at the QQQ, go to the Nasdaq and pull up its auto expected moves, the Nasdaq down mildly on the week. So what's the cause for concern? Like, why even bother mentioning it, right? Not listening to you, man. We're massively unchanged. One of the reasons you want to pay a careful attention here, the correlation jumped in the S&P 100 today. And yeah, we've seen that a bit lately. Okay, anytime you actually see correlation and this bifurcation inside of tech dissipated in the today's trade. And I would pay very careful attention because now we could see some follow through throughout the course of early next week inside of trade. And that would be even prior to the FOMC meeting, which does anybody really expect anything? Of course not, but push that aside. Even prior to the FOMC meeting, I think we're going to see some pretty good degrees of volatility coming back into play. We'll look at vol here in just a moment. But again, I just wanted to make that kind of quick statement here that tech, if you look at some of the moves that tech has made, again, just recently, this is big. It's a very big move. Again, almost a 2% move inside of the QQQ. But even more importantly than just, it's a big move. Like, who cares, right? It's a big move where everybody actually agrees with it. Okay, even Apple, which has been beaten up just a bit, and again, look at auto expected moves. You're aware that Apple is at the lower edge of its expected move. That thing starts to break down, things could get hideous. And again, bring back up Microsoft. Microsoft move is so substantial today, it almost brings us to the lower edge of the expected move. Okay, you start to bring up stuff like NVIDIA. NVIDIA is at the lower edge of its expected move. What's holding us together? As I was saying earlier, stuff like Amazon. Okay, so this, again, what has been this wild bifurcation where Apple has been slipping throughout the course of the week. Okay, really, that has not had huge negative implications to the marketplace because stocks like Amazon way outside their expected move. And the reason I'm going into so much detail about this is all of a sudden that whole logic collapsed today. And now everything's moving as one. If that just continues in the next session or two, real implications for damage, okay, to the Nasdaq and more importantly to the S&Ps. I mean, obviously it depends on what you're trading. All right, so tech, again, takes a collective hit. Triple witching. So a lot of people are going to point to today's trading activity and they're going to scream, it's triple witching, which most people have no idea. Look, okay, here's the bottom line with the big expiration, right? Why does it matter? First of all, see these S&P futures, okay? There were September S&P futures and there are December S&P futures. This happened at the cash open. All right, the cash open, there's actually a settlement. We officially, okay, have rolled from SEP to DC like a week ago, but there was still some activity in the September expiration, yada, yada, yada. Okay, the futures expired this morning. But there was also a big expiration specific to the September, again, the September AM settlement. Now, you're not going to see that on my screen because, well, it's over, it expired. But the September AM settlement, they go off of the morning of expiration, okay, and they go into settlement. There is trillions, and there was trillions, okay, of dollars in the SPX. And you go, why is there so many in that September? And actually, there's a pretty easy answer to that. If you look at the quarterly expirations specific to the SPX, okay, the quarterly expirations are often the biggest ones because they've been around for so long. And what I'm doing right now is I'm scrolling out in time because I want you to see exactly why it's so important. Like right here, if you look to, that's September of 2024. And we could even look further out in time. And the reason that the SEP, okay, is such a big expiration is, okay, the next September is already available. A lot of the options that you trade inside of the SPX or the spiders, okay, if they're like weeklies, they've only been around a couple of weeks, so they can only accumulate so much open interest, so much volume, so much open interest. But imagine if you lived, okay, as an option for 370 days. Look at all the open interest that's already starting, okay, to accumulate in the SEP of 24. So fast forward a year, it's a proverbial crap load of open interest. And guess what happens? In the AM settlement, okay, especially of options that are in the money, which we term have intrinsic value, ultimately, okay, there's hedges that have to come off. And those hedges coming off during like a triple witching, okay, and when I say hedges have to come off, market making firms are actually, slinging some big size inside of the SPX. There's hedges against them. Very difficult to discern exactly what some of those hedges are going to be, other than the hedges are in the S&P futures contract. The S&P futures contract, specifically here, the E-mini, is the hedge against the SPX. And what often transpires is, of course, as the SPX goes through settlement, stuff that had like intrinsic value immediately settles to cash, and they can actually rip the hedges down. And when they rip the hedges down, it can create all kinds of order flow and chaos inside of the S&Ps. Moreover, even products like Apple. Now, Apple, okay, just give you an example here, because Apple does some big order flow, but even like the September options for Apple, okay, now those are PM settlement. Here they are right here, okay? These are still trading. Look at some of the volume and open interest in them. It's staggeringly large. And the more size that's in there and the more size that's coming off the board at expiration today, the more volatility you could effectively create. So yeah, it's definitely wreaking a little bit of havoc, inside of the marketplace. But I think it just adds to the equation. That, okay, unto itself, though, don't listen to anybody when they go, it's directly responsible for volatility. It is responsible for some degree of volatility, but that would not explain why there's like this collective sell-off through and through. There's clearly something else going on in the marketplace, and that's why I say all quiet on the inflation front. Question mark, because it is a question. All right, so triple witching. All right, Fed is coming back to town. Why? The Fed's like Groundhog's Day. They just come out, he sees his shadow, 6 more weeks, and we get to wait for the next Fed announcement. But it looks like there's about a 98% probability the Fed is not going to do anything, okay? But their stance could be very, very aggressive. Some of the data, the reason I even mentioned inflation, okay, some of the data that came out throughout the course of this trading week, like CPI, even though CPI, everybody's like, it was nothing. It came in as expected. Yeah, but expected was higher inflation. Then PPI came out, that pointed to more inflation. I mean, almost every number that came out was, well, inflationary. Moreover, and I'll talk about this in a bit more detail, I don't like what oil is doing. It's as close to parabolic, for those of you that have no idea what that means, ever increasing slope to the upside. It's wildly parabolic. That is so incredibly inflationary. Okay, I'll just skip to the chase and just talk about oil right now. It's inflationary. It bothers me. Okay, bonds are getting rocked and might actually have a little bit of continuation to the downside. And I'm wrapping bonds, dollar, oil, okay, all into the exact same discussion. Interestingly enough, and I just brought up gold for this reason, like I'm a little perplexed inside of gold as well as most traders would be right now. Because gold, if inflation starts coming back, you're like, oh, gold's going to rock to the upside. But can gold really rock to the upside in a dollar that's this strong? Again, another chart that's just, it's shocking, okay, how linear. This one's not parabolic. This one's much more linear. How linear that move is to the upside. I can barely draw something so effective and efficient in that marketplace. So the dollar strength is actually putting a little bit of pain, if you will, into gold. But there's an interesting irony. If the dollar is so strong, why is it not negative implications to oil, right? And it just doesn't matter, because like oil at $91 a barrel, to me, I look at it and think, man, there's been strength in the dollar, like incredible strength in the dollar. So oil is even stronger than you would have anticipated. Does that make sense to everybody? Because if the dollar is going down, naturally oil goes up, because oil is priced in dollars. Well, in this case, the dollar is incredibly strong. Oil is not going down. Oil is actually exploding literally to the upside here. Again, very, very vicious moves, okay, in oil. Obviously, dollar is strong. And the last thing on that particular front is going to be some volatility. Now, before I jump into the volatility discussion, I want to wrap bonds around this, okay? Bonds, what have they done lately? What have you done for me lately? Absolutely nothing, except for the last 2 trading days. Now I'm getting a little nervous again. I think the better way to position bonds right now, people freak out when I mention bonds. They don't necessarily trade ZB. Look at the TNX. Now, the TNX is the 10-year. This is the 10-year interest rate. And the reason I bring it up, okay, far be it from me to be a big time market technician, but it does look like the TNX is about to rip to the upside. I mean, I would not discount the ability for the TNX late next week to be at 4.5%. And you're like, that sounds crazy. Yeah, here we presently are at 4.3. We could reach easily to the 4.5. I know it says 45, but the way to read this is 4.5%, 4.5% on the 10-year. I mean, you're like, well, that sounds insane. Look, the Fed fund futures are sitting, 525, okay, 525, 550. So why not? Why not have the 10-year actually extend a little higher in here? If you take a look also at the TYX is at 4.4%. So the 10-year and the 30-year are almost identical in this particular point in time. Oh yeah, I think we may actually see again the longer end of the curve start to really explode up when it comes to rates. And I think that this is unto itself one of the reasons, again, when I say all quiet on the inflation front, evidently that's not the case. It's not the case, and it can't be the case because interest rates are telling us something different. If interest rates are continuing to perpetuate, okay, the up move, which evidently they are, and they were very quiet the last 2 weeks, I'll give you that. But yesterday and today's move, it's more evidence. It looks like we're forming just a little bit of a base before we rip to the upside. And again, I am not a market technician, and I do not base interest rates. Okay, I don't base the move that I'm looking for in interest rates on interest rates. I'm looking at everything very, collectively and cohesively. The picture is dollar's incredibly strong. That looks like there's risk in the marketplace. Oil is just freaking ridiculous at this point, right? I mean, $91 a barrel oil looks absolutely ridiculous. Okay, coupled with obviously we just hit degrees of correlation in the marketplace. The Fed's coming back to town, which is probably going to amplify risk, which brings me to my last thought over here, which is volatility. You may look at this and you think volatility is lying dead on the floor, but my argument, okay, is a very, very simplistic one, and that's simply that what if VIX is a far more lagging indicator than it's ever been before? And I've been barking up this tree a lot, okay, on these evening videos. I was talking about this a little bit on Wednesday, talking about it live on TheoTRADE. VIX, it's just, look, one thing people have got to understand, okay, is VIX is all based on SPX. And the SPX, everyone's moving in the SPX, right, to the shortest duration possible. And to make a quick point, these are the 0-day expiration. And obviously expiration here happens the next, couple of seconds. But the VIX can't even see those. So the VIX can't even see those. And we go a little bit further out in time until like where the VIX really measures, which is right around 30 days to expiration. People, there's like no volume out here. There's nothing going on. Okay, even when you start looking at the 34-day expiration, which is the OCT20s, there's some size in here. I'm not going to discount the 24,000 contracts are open. Okay, but there's just not a tremendous amount. There's the closing bell. There's just not a tremendous amount of order flow in there like there is in the short duration. So we're seeing what I believe is a heavy 0 DTE volatility suppression trade, which in effect, what am I saying? I just don't really trust VIX as far as you can throw it. And I would keep that in mind for the days to come. I'll elaborate briefly upon that here in just a moment. Next in the docket, get your trade on this week's profits and losses. Look, today, specifically, okay, stellar. I was able to finally pull off inventory. Honestly, I didn't even trade that much today. I just pulled off inventory. I have a trade that's been on inside of the /ES options on futures. And the one that I cleared today is these 4800s. The 4800s, it's what I have called the unicorn. Okay, I have not been able to capture that trade. It's been like 90 days. I finally closed out of it. Profitable today. He shoots, he scores. So I closed my unicorn today, and moreover, over here on Tasty, Okay, and tasty, I had another unicorn I cleared today in the TheoTRADE, a small portfolio. That was the 4750 calls. Again, have also been on a substantial amount of time. So 50% gain. We're out of the contest. Last but not least, I've got trades on now. Bearish position inside of Walmart, bearish position inside of Microsoft. The Microsoft trade, ooh, this one's getting interesting, and I'm going to tell you exactly why. The Microsoft trade is getting interesting because it is down to the wire, people. Look at this. I've actually got 7 days left to expiration. Talk about being right on the dance floor. The Walmart trade's got 35 days, just bared up in there a little bit. I'll explain more about that trade next week, once again here at TheoTRADE. And of course, as we do each and every week, let's talk a little bit about the SPX Expected Move, okay? The trade that literally drives the entire marketplace. All right, we just passed through, okay, 5-day trading week. Right, I'm just mentioning that because the week before was a 4-day trading week. We just passed through a 5-day trading week. What was the expected move? Expected move was roughly plus or minus 59 bucks. You can see it right there. It's 59.21. And what did I say on last weekend's update? And again, I was always challenging people, like, go back, check it. I said it looks incredibly low. I said that $59 move looks ridiculously low because we were moving, 50, 60 bucks in one day. And ironically, today, SPX moved basically $55. The only point here is, look, we did, in fact, stay within the expected move. We did. It's the end of the week. We stayed right inside of that expected move. That's what those lines are. Nevertheless, you have a multitude of trading sessions here. Big gap to the upside on Thursday. Okay, we got within pennies of touching the upper edge of the expected move, only to revert back down, finish the week mildly lower. Okay, but now the marketplace, okay, and volatility has reared its ugly head. Question is, what are we going to look like next week? What is volatility going to set up for next week? Forget about VIX. Worry about the expected move exactly 7 days out. Look to the right side of your screen. Once again, we have a Fed meeting coming up, right? Yeah, of course we do. You're 7 days out. The expected move is basically the same as this week. And again, I pause for a second on that one. What do you think? I look at that and I go, that's ridiculously low. Feels like volatility is suppressed. Do not be a seller of premium, okay, in those short duration options. You'll get annihilated. We just saw volatility start to show up over here, right? I'm starting to question, when your degrees of correlation hitting the market, okay, is inflation making a comeback? Because that's the real thing that the Fed is going to talk about this week, okay? If there's the slightest inclination that the Fed is still nervous about inflation, you better believe you're going to move more than $60 in any given day, okay? And that's not any given day, people. That's for the entire week, all right? Buy the move, don't sell it. Buy short duration options, sell longer duration options. That's it for this week's update. All quiet on the inflation front? I think not. Thanks everybody for joining us here at TheoTRADE. Have a wonderful weekend. Bye-bye.